Crypto investors are panicking. Sentiment is at rock bottom levels, but the market isn't crashing, so what's really going on? While Bitcoin and a few top assets are holding strong, altcoins are bleeding out. Is this just another dip, or are we witnessing a structural shift in the crypto market? In this video, we'll break down why investors are so bearish, how leverage and regulations have made things worse, and most importantly, what needs to change for altcoins to recover. Stay tuned, because what you're about to hear might just change the way you invest in crypto forever. The market sentiment versus reality. To truly understand the state of the cryptocurrency market, it is essential to analyze not just the price movements, but also the sentiment that drives investor behavior. Market sentiment reflects the collective emotions, opinions, and expectations of investors, and it often influences short-term price fluctuations more than fundamental data. Recent reports from leading crypto analytics firms, such as Kaito, indicate a growing disconnect between overall market stability and investor sentiment. While the total cryptocurrency market capitalization has remained relatively stable, investor confidence has plunged to some of its lowest levels since the bear market of 2023. This discrepancy has left many investors confused. If the market is not in freefall, why does sentiment remain so overwhelmingly negative? The answer lies in the way total market capitalization is measured. Although Bitcoin, Ethereum, and a handful of major altcoins like XRP have managed to retain their value, the vast majority of smaller cryptocurrencies have suffered severe losses. This uneven distribution of performance creates an illusion of stability, when, in reality, most altcoin investors are deep in the red. Ethereum, in particular, has struggled significantly, with its price relative to Bitcoin plummeting to levels not seen since 2021. This suggests that Bitcoin's strength is not translating into a broader market recovery, but is instead absorbing liquidity at the expense of smaller cryptocurrencies. The factors driving crypto prices. The price movements in the cryptocurrency market are influenced by a complex interplay of both macroeconomic and crypto-specific factors. On the macroeconomic side, elements such as global liquidity, interest rates, inflation levels, and geopolitical events all play a significant role. Generally, when global liquidity is high, meaning central banks and financial institutions are injecting more money into the economy, risk assets like stocks, real estate, and cryptocurrencies tend to rise in value. Over the past year, global liquidity has been increasing, but unlike previous cycles, most altcoins have remained weak. This suggests that factors beyond macroeconomic conditions are preventing them from rallying. Crypto-specific factors, on the other hand, have had a more direct impact on altcoin performance. These include issues such as excessive leverage, evolving regulatory policies, and changes in market structure. Bitcoin has been a primary beneficiary of institutional interest, with major financial products like Bitcoin ETFs attracting significant capital. However, many altcoins have failed to garner the same level of institutional adoption. In addition, the rise of excessive speculation, unsustainable tokenomics, and a series of high-profile collapses have severely damaged investor confidence in the altcoin sector. Leverage and liquidations. How overconfidence led to disaster. One of the most significant reasons why altcoins have underperformed is the widespread use of leverage in the crypto market. Leverage allows traders to borrow funds to amplify their positions, increasing both potential gains and potential losses. While this strategy can yield substantial profits in a rising market, it also carries enormous risks, especially in a highly volatile market like crypto. Heading into late 2024, market sentiment was fueled by optimism, particularly after Donald Trump's re-election victory. Many traders speculated that his administration would introduce pro-crypto policies, leading to a surge in prices. This belief led to an explosion of leveraged positions in the altcoin market, with traders betting that Ethereum and smaller cryptocurrencies would soon experience significant price breakouts. However, when Trump officially took office, reality did not align with investor expectations. Instead of immediately prioritizing crypto-friendly policies, his administration focused on broader economic measures, such as imposing tariffs on Canada and Mexico. This shift created uncertainty, causing speculative traders to panic. As a result, when altcoin prices began to decline, the heavily leveraged positions triggered a massive wave of liquidations. Over $10 billion in leveraged positions were wiped out, leading to cascading sell-offs that further depressed prices. On centralized exchanges, more than $1 billion worth of cryptocurrency was liquidated in a single day, while in decentralized finance, DeFi, hundreds of millions of dollars in Ethereum collateral were automatically liquidated as prices dropped. This widespread deleveraging created a vicious cycle. Falling prices led to more liquidations, which, in turn, pushed prices even lower, making it nearly impossible for altcoins to recover. Altcoin dilution. Too many tokens, too little demand? Another major issue that has plagued altcoins is the sheer number of new tokens being launched in the market. Since the last bull cycle in 2021, over 40 million new tokens have been created across various blockchain networks. While some of these projects have genuine utility, the vast majority are meme coins or low-quality projects designed purely for speculative trading. This overproduction of tokens has resulted in what is known as supply dilution. With an overwhelming number of new cryptocurrencies competing for investor attention, it has become increasingly difficult for any single altcoin to gain meaningful traction. The market is now saturated with projects that lack clear use cases, causing investor interest to be spread too thin. As a result, even promising altcoins struggle to generate sustained momentum. One of the most notable examples of this trend is the Solana blockchain, which has become a hotbed for meme coin speculation. Billions of dollars have been poured into Solana-based liquidity pools for tokens that often have no intrinsic value or long-term vision. While this speculative frenzy has helped boost Solana's price, it has also drained liquidity away from other established cryptocurrencies, particularly Ethereum. As more capital flows into highly speculative assets, less funding is available for legitimate blockchain projects, further exacerbating the weakness in the broader altcoin market. Crypto market structure, regulations and KYC crackdowns. Beyond leverage and supply dilution, regulatory changes have also played a significant role in shaping today's crypto landscape. One of the most notable differences between the 2021 bull run and the current market is the increasing presence of Know Your Customer (KYC) regulations on centralized exchanges. In previous years, crypto traders could easily access altcoins through centralized exchanges without undergoing identity verification. This made it easier for both retail and institutional investors to move money freely in and out of altcoin markets. However, as governments around the world imposed stricter compliance requirements, major exchanges were forced to implement KYC measures. This shift has made it more challenging for investors in certain regions to trade altcoins, leading to reduced liquidity. As a result, there has been a significant migration of capital away from centralized platforms and into decentralized exchanges, DEX. Blockchains like Solana, which offer fast and low-cost transactions, have thrived in this new environment, while Ethereum, burdened by high gas fees and network congestion, has struggled to maintain its dominance. This regulatory shift has altered the dynamics of the crypto market, favoring projects that prioritize efficiency and compliance, while limiting access to riskier, high-growth altcoins. What needs to change for altcoins to recover? For altcoins to stage a meaningful recovery, several critical changes need to take place. First and foremost, regulatory clarity would be a game changer. If governments provide clear and favorable guidelines for crypto assets, institutional investors may feel more comfortable allocating capital to altcoins. This could significantly improve liquidity and market stability. Second, innovation within the crypto space needs to continue. The development of new decentralized finance, DeFi applications, improved scalability solutions, and real-world use cases for blockchain technology could reignite interest in Ethereum and other altcoins. Without genuine technological advancements, speculative trading alone will not be enough to drive sustained growth. Finally, a liquidity shift within the crypto market may be necessary. Historically, Bitcoin has led market cycles, with altcoins rallying afterward. If Bitcoin's dominance begins to decline and capital starts flowing back into smaller cryptocurrencies, we could witness the beginning of a new altcoin season. However, until that shift occurs, investors must remain cautious, selective, and well-informed when navigating the altcoin market. The crypto market is evolving, and while altcoins are struggling now, history shows that trends can shift in an instant. Will we see a major comeback, or are some altcoins doomed for good? Let me know your thoughts in the comments below. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update on the latest crypto trends. And remember, this video is for informational purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Thanks for watching, and I'll see you in the next one.